Okay guys, so if you find it hard to identify market structure correctly so that you can trade in line with the overall trend and avoid being on the wrong side of the markets for whatever reason this is, and you feel like maybe there's too much discretion in calling something a break of structure or change of character because everyone has a different view of the market and a different view of the concepts, and they might call something a break of structure which you don't, then I hope you find this video useful because I'm going to be giving you one simple rule that you can use with market structure, break of structures and change of characters to make the way that you look at the markets more consistent, which is the biggest thing that people struggle with. So if you go away after this video and implement this rule into the way that you look at the markets, do some paper trading, practice it, marking up market structure and seeing if you're correct in the way that you look at the markets. And I really do think that this will help you if market structure is something that you struggle with. So I'm going to be going through some basic textbook setups of what people might think a broker structure is and what change character is, and then we're going to be going through the charts to implement the rule. And I'll just mark up some market structure here for you live using this rule so you can get a feel of how I use it and how I interpret the markets. So your textbook market structure for a bullish trend is going to look something like this. You got your first bullish leg up, then a small bearish retracement, followed by a second leg up, another retracement, and then so on. And then obviously you're going to label both of these points here as breaker structures. So I'm just going to do that now. With your first breaker structure here, and then your second breaker structure at the next high over here, labeling them BOS just for simplicity, keep it short. But what this doesn't tell you is how do you know it's breaker structure? Because a lot of the time in the market you'll get liquidity grabs, which the high will get broken, but not fully broken, and then it will reverse on you. And you might think the structure's still showing that you're bullish, but in actual fact, the market's changing in direction and it wants to go bearish, and you'll get taken out being on the wrong side of the markets. So this is the first reason that traders get trapped up by market structure, thinking that every time a high is broken with price alone, that's a new break of structure, and then they might try and go long again from a demand zone down here maybe. But in actual fact, sometimes it could just be a liquidity grab, taking out this high, sorry, and then push price down to go short. And then the second reason traders might get trapped up by market structure is because they take this structure as the whole structure and they expect the price to move in these perfect zigzag lines. But that isn't what happens. This is your external structure showing the overall trend, possibly on the higher time frame. But then if you go to the lower time frames, you'll see the internal structure where you get a lot more mess and a lot more noise. So you could have something in this line. If you zoomed in, you could have something like this. The price makes these highs, but it has small retracements within, and I'll just talk about how this can trap you up in a minute. So we get that done. So this is what it might look like. But you'll see here, this looks like a change of character. You've got bullish structure here, highs getting broken, and you've got this low, which you're thinking is going to be a lower high when this high gets taken out. Then you get this point here and then a breakdown. So people might think that this is a change of character. We were bullish, but now we've had a break of the low, so we must be going bearish. But was this low confirmed as a higher low because this high hasn't been broken? Unless maybe you've got a higher time frame supply zone that's been tapped into and then you're going short. Even then, this is still quite a risky trade entry. But especially if you don't have any high time frame confirmations that you want to go bearish, then trying to trade off a change of character like this is just risky and not worth it. You're not going to have high win rates doing this unless you're an experienced trader maybe. Because what will most likely happen is price will continue in its original direction, because obviously the overall trend is most likely to continue playing out. Reversals occur a lot less than trend continuations. And so if you can identify when something like this is happening, you'll be able to ignore it and keep in line with the overall trend, because this is just a liquidity grab again. And you could even look to get in on something like this. Price could have gone up here, come back down to your liquidity grab, and then take off. So this is the bullish example. Obviously, bearish example is going to be exactly the same. So if you're not too familiar with that, then I think I've made a video on market structure, so you can look at that. But I want to get into the chart examples because that's where I'm going to introduce my rule and really help you. Okay, so if you want to keep things simple and easily improve your market structure analysis, then the rule that you're going to be wanting to use is candle close. And I'll explain what I mean by that when we get into the charts. But basically, if the candle doesn't close above the structure, then it's not a structure break. And it's most likely a liquidity grab, unless it's confirmed by, in the future, price closing above the high or low, depending if you're bullish or bearish. And that's really simple. It's easy to spot candle close. It's not discretionary. You just look at the numbers, and if the close value is higher than the high, then it's bullish. And similarly for bearish, if the close is lower than the low, then you've got a new low. So it really is this simple, and it's really going to help you understand market structure better and be able to identify it as well. Okay, so I'm just going to go down to the hourly time frame to get some more choppy market structure so we can really put this rule into action. And I'll just scroll back a bit to somewhere where it looks quite good. Maybe we'll just start from this probably news event that caused a big push up, because now you can see looks like we're going bullish. This is an easy place to start your analysis, and I'll do it together, explaining why I'm putting the points where I am, and we'll just go along. So if we start with, this is our low, then I'll just mark that up as the low of this candle here, and it doesn't matter which high we're looking at back there, we can ignore that, but we can call this our new high. Obviously there is still going to be some discretion on what you call a low. You could call this your high and then a lower low, and then your high up here, which is what I'm going to do, but all it's going to depend on is what is a big enough retracement for you to call it a retracement and not just part of the same leg. For me, this looks good enough, and as you get more experience, you'll be able to spot it by eye, but you can always create some rules for it as well, if that would help. And for me, I'm just going to put this in my high, and this is my low, but you don't call this your low until this high gets broken. So as you can see, this high, this candle here, closes above this high clearly, so this is a new high, which means this becomes our higher low. But again, only once this high has been broken by a candle close. So then I'll put my high up here, and until this high gets broken, we don't label our high low. You're not going to label this as your high low and then go up. You're going to wait for it to get broken over here, which it does, and now this can be our high low, and this can be our high. But as you can see, price continues up until we get a decent pullback here. So then I would call my high here. And just as an example, you get your pullback here, and what you don't want to do, which you might have been doing before if you weren't looking at candle closes and external structure. So let's say you mark this as your low, and then you see over here, you get a candle close below this low. So that means we're going bearish, right? That's what we might think. You might try and go like this. This is your new structure. You look like you get a change of character, and you're trying to get in here. You try and enter off maybe go to a lower time frame to get a supply zone, and try and short it down all the way down to this demand zone, maybe thinking you've got a really good trade, and then you get stopped out because the market is still bullish for now, which is not what you want to do. And this is why you wait for the high to be broken before you label this as your low, and that's how you can avoid fake change of characters. So I'll just label this up again, and then we'll continue with the analysis. And if you have any questions about what I'm doing here, then leave them in the comments or send me a message on Discord. Let's get back into it. So as you can see, we just draw a straight line over here, and you can see you get a candle close above this high over here. So then you just go to the lowest point in this range, which is here or here, and this becomes our new high. And again, candle close here above our high, so we just label this as our low, and then can get a high up here after we get a small retracement. And here's another thing that would catch you out. So I was talking about before, you might call this breaker structure, and then you've got your maybe low here. You go, that's your low, this is your new high. Then we get another change of character, is what you might think, and then you can try and go short from again lower time frame supply zone. And it might actually have worked out here, but so obviously yes, it might work out sometimes, but you don't want to get into the habit of doing the wrong stuff and being profitable with that, because it's not going to work in the long run, and what it's going to do is mess with your brain. And even a broken clock is right twice a day, so you don't want to take these setups. But if we just ignore this, once I reset it, then we're going to be waiting for this high to get broken, and as you can see it does here, this candle closes above the previous high, so now we can label this as our low, and our new high is going to be up here, and then we'll be waiting for it to get broken again. And as you can see, this candle does break above it, but it doesn't close above it, so we're not going bullish yet. Obviously, if in the future price did close above, then we would label this is our high, low, and a high, but it doesn't. So what we can do is wait for either this high over here, to get broken and closed above, or this low to get closed below. And as you can see, that happens over here. So then we know that this high over here is going to be, I mean, either high, doesn't really matter too much, but we'll label this one. It's going to be our highest high before the reversal. And then you can see, we'll label this as our low. And now what you can see is this low has been broken, and market structure has shifted from making higher highs and higher lows to now making a lower low, and then expecting a lower high and lower low and a lower high. And as you can see, that does happen. And this is where you can use change of character strategies, either from my channel or just from your own experience. But as you can see, candle closes below the low down here, maybe this one. You can check on the numbers when you're doing it live. But then this becomes our new lower high and our lower low. And so now we've got confirmation that we're bearish, and you can look down from this, just this order block here, refine it maybe a bit. And as you can see, price returns to this supply zone before selling off again. So it's very nice way to read market structure and then combine it with SMC for the entries. catch those sniper entries. And you can even look for confirmation within here, maybe on a 1 minute time frame if that's what you like. That's what I like personally. Everyone trades in their own way, so whatever you like, stick to it. And then back to the market structure, we're waiting for this low to get broken or this high. And as you can see, the low gets closed below. Again, remember that's the main rule that we're talking about here. When a body candle closes below one of our previous highs, that's when we get the confirmation the market structure is still in that direction. So we get that over there, and then this becomes our lower high and our lower low over here after this small consolidation pullback. And again, strong bearish candle closes below the low of this point. So then this becomes our new lower high and our new lower low. And then price pulls back, and we're waiting for this low to get broken. There's no reason to expect a reversal. We're looking for continuation trades, as well as reversal trade when they do happen, but we can be looking for continuation trades in this trend. So just something to note is that the highest probability trades will be the ones that happen straight after the change of character. So the one getting in up here. But you could also be looking for something in here, continuation, looking for a pullback to this supply zone, and then take the market down. But it doesn't happen here because we do get a reversal, which will happen sometimes, obviously. But what you do is, if the low doesn't get broken, wait for the high to get broken, and as you can see, candle closes above here. So I might just go to a lower time frame and we can look for some entries here. So I'll just mark that up, and then I'll use the replay tool just so I can do it somewhat live. And so we're on the hourly time frame here, so I might go to the 5 minute, and we'll just look for some supply zones with some imbalance. That's always a good confluence. So one thing I'm seeing, I'd wait for, yes, we don't get the market structure broken yet until we reach up here. Shall I just go back to the hourly? So I'll just wait for a candle close above the point, which we get then. So now I'll go down to the 5 minute, and we can look for some zones. Okay, so I already see something. What I was looking at just originally on the 5 minute before I fixed it was this zone here, and you can see that's already paid out nicely. But the next zone I'll be looking at is something like this. It's a nice 5 minute demand zone with some imbalance. And for extra confirmation, you can wait for break structure here on the lower time frame as well. So we can always just play this. Okay, and as you can see, using the same rule as before, you get break structure here when the candle closes above it. And now you can look to possibly get in on here, stop loss below there, and target wherever you want. I'll just put it there for now, but obviously you can target high, and let's see if it plays out. Okay, so it's just ranging. Okay, oh, and we get tagged into the trade. Let's pause that and update it. So then, yeah, you can target these highs or wherever. This isn't really an entry or exit strategy video, just to give you a simple rule to improve your market structure analysis. But we can go to a higher time frame, 50 minute, and just watch it play out, see what happens. Yep, so we would have hit the target, and it continues up. As I said, once you've got a trend, it can last a while. So, holding it all the way up there, nice 12%. You can easily pass a funded challenge in just one trade. But obviously that's not going to happen all the time, but this was nice to see that it does happen, and it's good to know that the rule does work. So hopefully that gives you some confidence, and then you can continue with your market structure analysis using the same rule. When you get a break off the high or a candle close, then you can look for pullbacks again. So again, here in this intraday, you've got push up, close above the high, so we're still bullish, and you wait for a pullback, maybe a 5 minute, and then go long again. Okay, and just two more things. First of which is, obviously this is on the 1 hour time frame that I'm using on, and AUD USD, but it doesn't have to be. You can use it on any time frame. You could use the daily and maybe an hourly for entries, or you could use the lower time frames if you really wanted to. Market structure is going to be more key on the higher time frames. It's going to hold more weight and more power in the overall trend. But you can use whatever time frames you like and whatever pairs you want. But the higher the time frames, the better. The hourly is quite good. 4 hourly is quite good. And if you've got the patience, than the daily, but you'll get a lot less trades. And then the second thing is that if you have made it this far, and if this has been helpful to you at all, then please do leave a like and subscribe to the channel and join the Discord if you're interested in that. Obviously it's free and you can chat to me, chat to other traders, get some analysis and grow as a trader. But thanks for watching and I'll see you in the next one.